Okay, everybody, Mike Lieberman, Dr. Charles Lieberman, Chief Investment Officer, Advisors Capital Management, 10-second interview show. Chuck, I'm going to ask you a couple of questions, 5, 6, 7 questions. You got 10 seconds to answer each one. If you need a little extra time, I'm going to give it to you because the market is on the move today. A lot of pressure. I want to get this out of the way in advance. Like and subscribe because I'm not going to remember to say it later. Okay, Chuck, market's selling off today. Volatility spiking up in a big way. A lot of this has to do with what's known as the Japan carry trade, right? Coming undone in a violent fashion. Very quickly, what is the carry trade? Go.
So interest rates in Japan were around zero or negative. So it was very cheap to borrow. And a lot of institutional investors borrowed in yen, converted their yen into dollars and euros, and invested overseas to pick up yield. So there was a very substantial positive carry. The risk in that trade is that Japan raises interest rates. They then want to unwind, and that's what we're seeing happen. Japanese stocks are down sharply. The yen is rallying as the dollars get converted back into yen.
So the theory, right, was it was safe to borrow from Japan because they were still at zero interest rates and Japan hadn't raised interest rates in forever. So it was no problem. You could borrow from Japan at zero, the Japanese central bank at zero, and reinvest in assets that yielded more. And then last week, Japan raised interest rates. And so a lot of people were kind of caught off sides here, right? The cost to borrow got higher, but then the yen also strengthened against the dollar, and so you got pinched on both ends of that trade, right? And you can see that there's all sorts of charting out there about this, where you can see the strength of the yen. Okay, so with that, right, that led to incredible volatility on our end. The VIX is blown out, 10 seconds or less. How long do you expect this volatility to last?
I think it's going to pass reasonably quickly. Obviously, the trade itself became very, very painful because you were hoping to make 300-400 basis points of profit of carry per year, but the currency weakened by 12-15% in the span of several days. So you're immediately losing a ton of money. So that's why the trade is reversing, and that means that foreign investors or domestic investors are reversing it. So they're selling off dollar assets. Our stock market is down. They're buying yen to pay off their loans. That strengthens the yen.
Now, some things have gotten crushed worse than others. At least earlier this morning, that was the case. AI-related stocks, Bitcoin, cryptocurrencies taking it on the chin. It's likely, just so people get a real good framing of this, that the assets being sold to cover that blown-out levered trade from Japan could be these things that you see on our market that are getting killed today.
Well, actually, it's likely that everything is being sold for that reason. So Japanese investors or U.S. investors who borrowed in yen bought dollar assets. Fine. They spread that money around in every market. Some people bought treasuries. That was a more conservative way to play it. Some people bought U.S. equities, less conservative, but still on the conservative side. Some people bought European assets, but some speculated in Bitcoin and more aggressively in AI stocks.
Is it possible, I don't even know if you can answer this, but is it possible to determine how much pain there is that has been spread around? How much, how levered were certain institutions, traders, funds? How big of a problem is this?
It's hard to know. Those kind of questions are answered at the individual firm level. There are plenty of firms around that had no exposure to that trade whatsoever. And then, of course, some hedge funds probably had pretty sizable exposure. It's entirely possible we'll find out that some hedge fund collapsed as a result of that trade.
I mean, who would have thought that one of the big Japanese exports this year would be leverage? Okay. Then on top of that, right, you have incredibly weak jobs numbers coming out of the U.S. last week. I don't want to say incredibly weak, right? We still picked up 114,000 jobs announced on Friday, but there were revisions down to numbers across the board. Unemployment rate up. This number missed expectations. You got people screaming, for an emergency cut by the Fed. The Fed isn't doing anything until September. Does the Fed need to cut interest rates, and is an emergency cut likely to solve anything?
No. First of all, some people are panicking. Some people are flamboyant and make extreme projections. This is not that kind of situation. The job market is still very solid. Domestic labor force growth is 50 to 100,000 per year. We exceeded that. All of the incremental hiring is coming from immigration. Our borders are open. Lots of people coming over wanting jobs in the United States. And that's made it possible for the economy to grow so quickly. The rise in the unemployment rate suggests that some of those people coming over are having more difficulty finding jobs. But the economy is going to continue to grow at a solid clip. That's what that kind of job growth implies. So a recession is not imminent, and there's no need for urgency on the Fed's part.
Immigration hot take. I love it. Okay, so broader picture, market's gone up for like 18 months straight, right? A long time. This is a correction induced by a Japanese leverage type scenario. Traders caught off sides. Would you be putting money to work now? Last question, go.
Yeah, I would. I think that from a long-term perspective, stocks in the U.S., most stocks are reasonably valued. We can debate the Magnificent Seven, but the economy is not likely to go into recession. And as long as that's the case, and you have the Fed likely to lower rates to provide a floor under things, I think stocks are still attractive.
All right, so obviously with the market previously trading at all-time highs, there's been nothing that haven't come back from before, so I guess that's a good thing. With that, like and subscribe. Chuck, thanks for the time today. Appreciate you. We'll be back when there are more market-related items, news stories to cover. Thanks, everybody.